you need to differentiate to some degree. Like, how are you holding cash? If you've got
In the mattress.
yeah, exactly.
Under the mattress.
That's probably the worst way.
Yeah.
But if you've got a mortgage and you're putting it in the offset account, then there's an argument to say that, okay, in this environment where maybe your interest rates are at 6%.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host.
Andrew, Bills, here we are back on the audio waves.
Andrew, we are back week in, week out. We absolutely love this stuff. What are we talking to everybody about today?
Today, what we're talking about is really the big financial mistakes that we see people make each and every single week, and exactly what you can do to avoid it. Because we do see things, and it's not about, I think that the big key takeaway in all of this is that you think, oh yeah, big financial mistakes that people are making, it's those big obvious things. But no, this is the financial mistakes that people make when they actually think that they're doing the right thing, as opposed to, going out and buying some, speculative asset that's, essentially worthless.
Yeah, no, look, I think this is a really great topic because, not only is it a good insight into what we see and sharing our knowledge and experience here, but yes, they are big mistakes, costly in terms of dollars and also time, but they're not, once you know what they are, they're not that hard to mitigate. Yeah. And then if you go one step further and get advice and what have you, it'll make a little bit more sense later on. But yeah, really excited to bring this one out. Andrew, where do we start? This is probably the biggest one that we tend to see, right? And probably a bigger issue and consideration now than what it has been in the past.
Yeah.
Where do we start?
So we start with first, what's the structure and what name are you purchasing assets in? So, there's kind of your big three, so to speak, or maybe four, where you can purchase assets in a trust, you can purchase assets in a company, you can purchase assets in a personal name, or you can own it in superannuation, which more or less is kind of like a trust. Now, each of those asset structures, or each of those structures are going to have their own benefits, they're going to have their own costs. And in any structure, you're doing cost benefit analysis and you're looking at, all right, on this side of the tick column, this structure is right. On this side, this is the detriment of that. And you're doing a bit of a balancing act and trying to preempt what your future self is going to need. But yeah, buying assets in the wrong name is just such a massive one.
Yeah, and that was probably an easier question or issue to mitigate in the past. Yeah. You'd be able to fairly easily calculate that and, position it for a few things. Let's talk about, I guess, the crux of this. What are we talking about? Wrong structure. And there's two positions or 2 points my mind goes to. The first one is from an asset protection perspective.
Yeah.
Okay. So what does that look like? What does that mean? Basically, you're trying to put it in a particular entity or ownership structure to then prevent any potential creditors down the track getting access to that. So asset protection. Then the second thing is if we look at it from a tax minimization perspective, and I think for a long period of time, that's where people's minds went. Obviously, the game has changed with the changes to capital gains tax. Yeah. So getting around that is a little bit more, or managing that is a little bit more complex than what it used to be, but just sort of digging a little bit deeper and going, okay, is it both of those things that we're trying to achieve? Is it one? Is it the other? What's the trade-off and what do we need to do? So that's become a lot more complicated now, but still something to take into consideration and still one of the things that is one of the bigger issues that we see in terms of people making this code.
Like, I'll use an example of a client at the moment. They purchased a property that they're living in, so an owner-occupied property. Now, this is an extremely expensive property. Was extremely expensive when they bought it, and the capital's only appreciated significantly more since. When they purchased that property, which was a number of years ago now, the advice at the time, which was not by us, just full disclosure, was to purchase that property in a company structure, and was to purchase it in the company structure because they wanted to offset a portion of the interest on mortgage against a company. I mean, you know, question whether that was legal or not. Yes, they did run some of their businesses. Each of them are self-employed, but some of their businesses out of it. But anyway, now their businesses appreciated in value. They made some fairly hefty profits. They have expunged the mortgage, so they did not essentially earn or did not utilize too much of the benefit of claiming some interest against that mortgage. But living in an owner-occupied property that's owned in a company structure, the land tax bill is eye-wateringly insane. Yeah. In addition to that, they are now in a position where they're downsizing that home. And because they're downsizing an owner-occupied property, normally you would not pay any capital gains tax now that kids have moved out. But because it's in a company structure, you can't claim the benefit of not paying capital gains, even if it's an owner-occupied property. So they're going to now pay capital gains tax on the sale of that property. And it just goes to show that one, seemingly, and most people think that it's a significant decision, but don't understand the significance and importance of getting your structure right for the right type of assets. I mean, maybe if it was an investment property, you could argue that that structure might have been okay, but holding the right assets in the right structure is just so hugely important. And potentially, there may be some opportunity in all of this because of the recent budget announcements. Now, we don't know exactly what it's going to look like. Some people may have the ability to restructure their assets in light of budget announcements without triggering stamp duty, capital gains, all of that stuff that you normally would trigger. Now, it's been touted as being able to restructure as a result of the budget announcements. But there could be a cohort of people that just have had the wrong structures from the beginning that can restructure without too many implications. So there may be some opportunity in that.
That example you shared is the actual definition of a comedy of errors, Andrew. That's crazy. That's crazy. Second one that we see that and I understand why this happens, but insurance has not been reviewed for a period of time. So let's talk about what we usually see. Got young children. Okay, it's something that we need to consider. What if something happened? Okay, let's get X.
Yeah.
And that X just stays in place and you don't really give it much thought. And every year the premiums come out and they sting a little bit. However, in saying that, you're not actively reviewing it. So you don't know if you've got the right amount of cover, if you're paying too much, if your situation has changed, debt levels, income levels, equity position, wealth position. Are you paying for cover that's no longer needed? Are you paying more expensive cover where you could get something more competitive on the market? Have you got cover that has outdated policy terms? Whole range of issues. And the problem is that you're leaving opportunity on the table. And, in that instance, I think what you could do is if you get it reviewed and looked at, you could then potentially move stuff around and utilize that funding or that premium in a better way if you are paying overs.
Yeah. And there's so many different issues that could transpire where you haven't reviewed your insurances, like whether you're uninsured or whether you don't have enough insurance if something happens and you're not, what we've found is not protected. But some of the other things that we've seen, like holding an income protection policy that's an indemnity policy, and your benefit amount is up here, but your income has actually gone down, and all of a sudden you're paying for premiums that even if you were to claim, you're not even going to get paid out. So reviewing insurances to make sure that it's fit for purpose, to make sure that it's cost competitive, to make sure that it's got the right protection in place and you're not paying too much it's so important because, insurance is peace of mind. And so you want to have the peace of mind that, I'm actually protected.
Yeah, exactly right. Exactly right. Andrew, the next one, holding too much cash. That almost sounds wrong to say.
I know.
Almost, but I'm sure we're going to unpack it. Why does it feel almost wrong to say? What do we think about? How come this is an issue that people experience?
Yeah. I think when you're talking about too much cash, you need to differentiate to some degree. Like, how are you holding the cash? If you've got
In the mattress.
yeah, exactly.
Under the mattress.
That's probably the worst way.
Yeah.
But if you've got a mortgage and you're putting it in the offset account, then there's an argument to say that, okay, in this environment where maybe your interest rates are at 6%, it's offsetting a 6% interest rate after tax. Maybe that's not, too bad of a thing when you're talking about this environment. Different story if interest rates are maybe at, say, 2%. The other thing we really commonly see is like someone's paid off a mortgage or sold a property and expunged the debt, and there's hundreds, if not, millions of dollars at times that's sitting in a bank account.
Yeah.
The issue with holding too much cash is, there's a multitude of issues. One is you're virtually guaranteeing that you're going to lose money.
Mhm.
So inflation is going to erode, any interest that you're receiving, depending on what inflation rate you're talking about and what level of interest. In addition to that, the opportunity cost of not investing that money and not having it in the market is a significantly large missed opportunity. The other thing is, at least in my experience, and it's not something that you can tangibly put down, pen to paper and say, okay, this is exactly how much it costs you. But when you hold a huge amount of cash, getting rid of that and reversing that position is such a large step. So let's say you've accumulated hundreds of thousands of dollars in a savings account. Well, okay, the answer is simple. You pull a portion of it out and you invest it. But the emotional attachment and security to having such a large buffer in play makes it feel like such a big step to make that decision, and usually means that it takes a number of years to reverse that position, at least in my experience. So holding too much cash, now, while it may seem and feel like you're doing the right thing at times, it really can mean that you're essentially either guaranteeing that you're going to lose some money over time or just missing out on opportunities to have that money invested and grow.
Yeah, and I might just add a little bit onto the back of that as well too. So we obviously advocate for people to hold a portion of assets, in particular cash, in some sort of liquid form so you can get access to it. Think about it as a, emergency money, or just in case money. And we advocate for having a certain amount that is scalable depending on somebody's circumstances. So, we've gone through this heaps of times previously, but if you've got, high job security, a lot of sick leave and annual leave, maybe your cash reserves can be a little bit lower. Maybe if you're a seasonal worker or your income fluctuates, it goes the other way and you need a little bit more. So we're not saying that needs to go. What we're saying is once you've got your core and your base, the idea is that you've got enough, and then anything in excess of that should then go to something else, investing, paying down debt, and so on and so forth.
Yeah.
But I think a lot of people, you're absolutely right, a lot of people feel safe that the more cash they've got, not realizing, so conceptually it's okay, but not realizing that with inflation, where we're currently at the moment, you're actually going backwards.
Yeah, exactly. Super. That's another massive one. Now, treating it as future Billy's problem.
Yeah, you know what I mean? Look, everybody thinks they've got more time than they do. I think, you get 5, 10, 15 years into your career and you go, geez, that went quick. So it's something that you can't take for granted. And we're so fortunate in this country that we've got the superannuation system, and you're forced to invest for a long period of time. You can't touch it. Whether you want to or not, you can't do anything about it unless you meet a certain set of circumstances. But the fact that exists, it allows it to compound. And the more love and attention that you give it throughout your working career, the greater the benefit it will be at the end of the day. However, if you treat it as a future problem and something that, you don't want to have to think about or worry about until you're older, you're missing some really critical, call it almost decades, where you can almost add, I don't know, supercharge this thing to get from, A to B.
Yeah.
It's just insane about how much of a difference that you can make if you give it some TLC.
And you really need to consider it as an asset. So, we talk about purchasing assets and we talk about the name that you're purchasing, assets in. Superannuation is just another means to be able to hold assets in a low tax environment, get a tax deduction for putting money in. Like it's so hugely beneficial, and not seeing or not knowing, which investment option is invested in, not knowing, do I have it across multiple accounts? Am I paying multiple sets of fees? Is my employer even paying contributions? The amount of times that I've seen that an employer hasn't paid contributions into an account, but people don't check it, they don't know, and all of a sudden the business goes into liquidation and it doesn't, the money never gets paid. Like there's so much power in the small decisions that you make over time. So particularly if you're young, rather than needing to say, okay, I'm going to put an extra, 10, 15, 20 grand a year into super and I'm going to max out my concessional contribution. But so we sacrifice $50 a week. Yeah, you're going to feel it and you won't even feel it.
Not going to feel it.
It's going to be a tax deduction. So you're not even going to have a $50 a week impact. It's going to be less than that, maybe 30. Your impact that you're going to have to the growth of your super fund, but doing that consistently over time is massive.
Yeah. It's amazing how with a little bit of love, where it can go. Andrew, next one that we tend to see is the investing. Call it the DIY investing, and I get it, without a strategy.
Yeah.
So you kind of recognize that, yes, okay, I know that I need to be growing my money.
Yeah.
And that's about as far as the thinking goes, and just chuck it here, chuck it there. What is it doing? What's my time frame? What's my risk appetite? What's my diversification? Is it concentrated? And one of the problems is that there's so much noise out there that you could look at, 10 different things online and get 10 completely different opinions, and all of them will be wrong. Yep. Well, all of them carry risk that people don't really understand. Why do we do it to ourselves?
I think it's the allure of, I'm going to make this one really good decision and that's going to solve all of my financial, problems or worries. But just investing without a strategy is like getting in the car and just driving and hoping that you're going to get to the destination that you want to go. We see it all of the time. And normally this either leads to I'm investing in last year's best performing asset because all I'm looking at is just the recency of how things have performed. Or I've just, I've accumulated some assets. It's a relatively small amount and I've just bought a couple of things. Back in the day it was stocks. These days it's ETFs. Everyone's heard of, or not everyone, but a lot of people have heard of ETFs, and people are just buying, hey, I've purchased an ETF, which may not be a bad thing.
Yeah.
Right? Like an ETF could actually be a great investment for you. But doing it without a strategy, what that usually means is, oh yeah, I took $5,000 out of savings and I put it into an ETF because it sounded like the right thing to do. And then I stopped there. And in 10 years' time, you might have 10 grand or maybe 15, but it hasn't changed your life at all. Versus the person that's doing it with a strategy and maybe didn't invest $5,000, but invested a couple of $100 a week.
Yep.
And over the course of a few years, that gave you access to hundreds of thousands of dollars worth of assets. Like not having a strategy is, you're almost gambling as opposed to actually investing.
Yeah, and I think the other thing as well too, and we see it too with, I guess, people that are starting out on the investing journey. When let's chuck some round numbers out there, right? Let's say you invest $10,000 and in your first year you get a 10% rate of return. 10% fantastic rate of return. That's $1,000. So somebody might look at it and go, I only made $1,000. Yeah, but it's not the $1,000 because that's based on the amount of capital that you've got in there. It's the percentage-based return. So they might look at it and then they go, oh, this isn't doing enough. So I want to change the strategy and I want to invest in this. And I heard a friend of mine bought this and it went to the moon and hold on for dear life and all this other crap that you hear. But they're focusing on the wrong thing. And I think it's really easy to get caught up in the noise, investing based on headlines, investing based on tips, chasing last year's performance, and ultimately having an unrealistic expectation of where it goes. You're not going to buy something for $10,000 and it's going to turn into a $300,000 investment overnight.
And if anyone is telling you that it will, then they're either lying to you.
Well, they're probably trying to rip you off.
Yeah. Or that's the right bill, or that's very likely what it is. So, when we're talking about, particularly when you're talking to someone that's just starting out on investing, many or all of our clients would have heard us say that this is not going to change your life. Like if you invest 10 grand, if you invest 20 grand, if you invest 50 grand, like a 10% rate of return is 5 grand. It's not going to change your life. That's not what you're doing
At the start.
Correct.
Yep.
What you're doing it for is, one, you're getting used to investing, you're understanding how it works. Two, you're investing an amount of money initially, but you have to be putting ongoing contributions to it unless your initial investment is so substantial in nature that you don't need to. But you have to be putting ongoing contributions to it in order to grow it over time. Real wealth takes years to build. And if someone is saying, or someone is promising you that it's going to take months or a year or 2 years or 3 years or 5 years, then very likely they can't rip you off.
Andrew, one of the big things that we see, the people that we talk to, debt is part and parcel of your everyday life, whether it's home loan debt, whether it's investment debt. What are the things that we see from a debt perspective? Because I reckon that's the one that's going to prick a lot of the ears when we're talking to people about this.
First things first, just get rid of that consumer debt. Personal loans, credit cards, car loans, Afterpay, even if it doesn't accumulate interest, like it's all just working against you. So the first thing that you need to consider before you even get started on the investment journey is, let's get rid of that really bad debt. Then the next step is, okay, what other mistakes do we see? Is I'm paying off my deductible debt, so my investment property, as opposed to paying off my non-deductible debt. And the reason that sometimes people make that mistake is because it's not intentional. They're not actually paying it off. They're just holding money in the wrong offset account. So quite literally moving money from one offset account to another can make a big difference. Or they're not utilizing an offset account because they maybe don't understand how an offset account works. And they're not necessarily putting money in an offset account, but holding money in savings. So debt can be extremely powerful. And we are not the type of people that are going to say, don't hold any debt. Your Dave Ramsey's of the world, and you don't do any investing until you've paid off your debt. I think that debt is a very powerful tool, but it needs to be used in the right manner.
Yeah.
And you need to know why and how you're utilizing it.
Yeah. And just to add to that, so not only paying off the consumer debt and getting rid of it, never getting into that position again. So it's not just like, okay, I'll pay it down to zero, and then the habit or the issue or the reason that I got into this is still present. You need to kill that completely. That needs to disappear, because what it does do, it represents, I guess, the ability to overspend and leakage out of your budget. And that's probably the next thing that I'll pivot into along with debt, sort of parallel to it, but not exactly, but with credit cards, because what it does do is it gives you the ability to spend more than you should.
Yep.
Or that you've allocated to a particular thing, because there's a limit, but you need to spend in order to hit that limit. So I think one of the things here is not only getting rid of the consumer debt, killing the habit, and also at the same time, if you're running your budget on a credit card, and you can tell yourself, I've heard the story a million times around the points game and all that sort of stuff, it's all crap. It gives you the ability to spend more than you earn, and you're not optimizing your financial position as best as you could. So that's probably the one that sits parallel to that. And then lastly, I think, ultimately, and we don't get to see it too often because pretty much every client that we talk to proceeds with our advice, but having a financial plan that never gets implemented. It just stays as it is, as an idea, as a thought, and doesn't go anywhere.
Yeah. And look, I think that it doesn't, as you said, in our world, it doesn't happen very often, if at all, because most of the time when we're sitting in front of a client, there's value in that. They see the value, and they usually wouldn't come to us if they weren't interested in actually implementing a plan. Now, maybe where this rears its head more commonly is when you're talking about, I'm going to purchase that asset, or I'm going to get in at the perfect time. You know, you see it in property all of the time. I'm going to buy the property when the market drops, X% and gets to this amount, when you're missing out on all of the growth by delaying that decision. So putting things off is ultimately what we're talking about here. Whether it's purchasing a property, whether it's getting your insurances and then it's too late and all of a sudden, there's underwriting issues and you can't necessarily get insurance cover, whether that's putting off, wills and estate planning, whether that's increasing super contributions. But a lot of the times it's the paralysis of analysis and people trying to do things perfectly as opposed to taking a positive imperfect action.
I like that. That should almost be a quote on the wall.
There you go.
There you go.
Got my name written under.
Thanks, Ian. Put it on your business card, Andrew, for sure. No, you're absolutely right. I think that summarizes it nicely. Andrew, what did we cover? We covered 7 things for people to think about and consider in terms of the biggest mistakes that we see. So recapping, buying assets in the wrong name. First one, insurance that hasn't been reviewed for a long period of time. Third one, holding too much cash. Treating superannuation as a future problem is the fourth one. The fifth one, DIY investing without a strategy. Number 6 is the debt piece and not managing your debt properly and probably not understanding it properly. And then lastly, having a financial plan that never gets implemented.
Bills, well summarized, and hopefully there's a whole heap of value in that podcast. So if you did get some value out of that, please like, subscribe. It really does help us. And we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.